In today's market, sustainability is not just a preference, it's a driving force. Consumers are increasingly making choices based on environmental impact, reshaping how businesses operate. This shift is more than ethical, it's economically savvy. Companies aligning with sustainable practices are finding it profitable as eco-conscious decisions resonate with customers. Globally, a significant eco-awareness is emerging, especially in developing regions. This rise in environmental consciousness is compelling companies to prioritize green strategies and transparent practices. To catalyze this shift, businesses are adopting techniques to guide customers towards sustainable choices, creating a market where eco-friendliness is the norm. This strategy benefits society and shareholders alike, proving that sustainability can coexist with profitability. We're at a tipping point in consumer behavior, steering the direction of sustainable investing. As more individuals choose eco-friendly options, companies are responding, fostering a cycle of sustainability that's redefining consumerism and investment strategies. This emerging trend signals a new era in the marketplace.
Morgan, how has the Candide Group leveraged consumer behavior trends to drive investments in social justice? And maybe can you provide an example of a successful investment influenced by these trends?
Sure. I think two elements. Gosh, there's so many. And I think that's part of what's exciting in the context of moving into this space, of people being so much more conscious of any number of consumer choices that they're making. So whether that's in food systems, the environment, within racial equity and inclusion, so many different ways that we're able to express values through investment. And with that, I think we're also thinking a lot more definitively about who gets to decide what social change is, and that often it can't just be people with wealth, right? Particularly if we're talking about poverty alleviation, whether in the US or elsewhere. How do we design structures that really shift decision making so that we're not making decisions about other people's lives? So we have two debt funds within Candide Group, one called Olamina that's focused on US community development, and another called Afterglow that's a climate justice fund. And in both cases, we have community advisory boards, which are community members and activists who really have that in-depth lived experience, who get to help determine the pipeline, who have final veto power over investments in some cases, and are really able to ensure that if projects are going to be impacting their communities, that it's going to be in a positive way. And that one of the things with impact investing, the Merriam-Webster definition of impact is just to impinge upon, especially forcefully, and that could be good or bad, right? And that's where we need to make sure, I think the same as you're seeing the consumer trend of people becoming conscious consumers, it's not enough to just see an ESG label slapped on a product. And we've actually seen, I think, thoughtful regulatory action from that perspective of you actually do have to show that you are improving the lives of people and the environment if you're going to call something an ESG product, and that we all need to be conscious consumers to make sure that's real. Now, we would say that that's real if the people who are impacted actually got a vote. Right, the idea of nothing about us without us, as opposed to external people always getting to make those decisions. So that's something within our investments that I think we're very conscious of.
Mike, in your experience, what role does consumer advocacy play in shaping corporate behavior towards sustainability?
Well, I think it's growing. It's especially been had an impact on the environment. There's no question that the E in ESG has been developed quite significantly over the last 20 years. I think it's much less so on the social side. And that's really where I think that's where our energy is going. And we need to see also in situations where environmental and social issues come into conflict, we need to deal with those issues. Your video had two images, one of an electric car, the Tesla. Inside the Tesla is a battery. The battery is fueled in part by cobalt, which keeps it from burning up. The cobalt's mined in the Congo, and there are 25,000 kids working in those mines. So I'm all in favor of the move to electric vehicles. It's essential. Our environment is threatened. But we need to be aware of the underlying elements that make that battery work, that make that car work. The other image was of solar panels. Solar panels are manufactured overwhelmingly in China. And an important component part, the polysilicon wafers and ingots are manufactured 98% in Xinjiang, in China, part of China, where Uyghurs are subject to forced labor. I want solar panels coming into the United States and around the world. They're a good part of a smart investment strategy on environment. But we have to be aware of and think about what are the ways to begin to wean ourselves of that situation and not be actually contributing to forced labor in that situation.
Do you think that the social is lagging environmental because it's more difficult to measure on the corporate side, or is it just a matter of focus and time?
I think it's more difficult to measure, it's riskier, and it's more expensive. So I think if the notion is, if we start to look at, ESG measures are essentially looking at risks to investors. There are costs to doing the kinds of things that I'm talking about. If you formalize those informal ASM, so-called ASM mines in the Congo, there's a cost associated with that. If you begin to look at and really develop data about workers in, let's say, a global supply chain for manufacturing or farming, inevitably you're going to find out that people aren't being paid enough or they're working in substandard conditions. And that's going to cost the companies money to fix. And so I think part of it is it's harder to measure. Part of it is that it's more expensive. And it flies in the face of a notion of return on investment in the next quarter. You just can't make the case as easily.
I want to welcome in our fourth panelist, the Reverend Kirsten Snow Spalding. She's a multifaceted leader serving as vice president of the Ceres Investor Network at the sustainability nonprofit Ceres, with a background spanning government, labor activism, law, and academia. Kirsten brings extensive experience to her role, complemented by her education as an Episcopal priest, a wife, and a mother of two. Welcome, Reverend.
Delighted to be with you all and fascinated by this conversation. Thank you, Michael, for your comments.
I'm so glad that you could join us and make it. I'm wondering, maybe you can share with us the Ceres Investor Network and the institutions that make up that group. How do you see a connection between consumer behavior and the way that the members are investing today?
It's a really good question. So I work with large institutional investors. My network is a mix. We're about 220 some investors now. We range from socially responsible investors who have a long history and looking for impact and basing their investment strategy on their values, to really large multi-asset class managers. You'll know the names: BlackRock, State Street, big asset managers who invest in everything in the market. And they're joining our network because they're interested in trying to address sustainability risks and look for opportunities in the new economy that's coming. So they have some products that are dedicated to values or impact, but they also are thinking about their entire portfolio and recognizing that some of the issues that we care about are really material to the investments that they're making. They're financially material: climate change, biodiversity loss, water, human rights, communities, and the impact on communities of environmental and other sustainability problems. Those things really matter to these big investors. I also have pension funds and endowments and foundations, but they've all come into the network to work on a range of sustainability issues. Andy, your question about how does consumer interest impact the investment strategy? When an investor is thinking about what they want to invest in, they want to be ahead of the curve. That's how they're going to make money for their beneficiaries or their clients. So they're looking very carefully at where's the economy going? What are consumers looking for? They want to be in the products and services. They want to be resonating the themes just a little bit ahead of the market. That's how they're going to make money. And they want to be addressing things that are really going to be risks to their portfolio in the long run. So what we know is that consumers are demanding more green products, that there's no room in the market now for things that ignore sustainability from an environmental perspective. We know that there's a rising concern about income inequality, poverty, particularly in the global south, the ways that the developing world has not really allowed the emerging markets to grow and really get what they need to thrive, and that we're all interconnected. Especially young people really hold this as a high priority. And so investors are really thinking about what sectors, what companies, what investments are going to put them in a position to build on that consumer demand, I guess. Yeah.
Carole, can you speak?
Maybe I'll just give one example, because you were talking about EVs and I jumped in. So investors are engaging with Ford and GM and Toyota. And they're saying to those companies, look, you got to get ahead of this electric vehicle trend. You can't just continue to build Hummers. You can't build these huge energy guzzling, fuel guzzling vehicles, because that's not where the consumers are going to go. So if you're going to be a leader in the new economy that's coming, you've got to start shifting your product. And that's really important to the investors, because they want those companies to thrive.
Thanks for the example. Carole, can you speak to, like, if investors are interested in investing, supporting ESG, looking at a mutual fund versus an ETF, can you give us some context? Like, where does one start?
Well, we like to say, especially when you're dealing with impact investing products, there are tools in the toolkit that can be put to work to align your investments, to harness the power of your savings to help build a better future and a better world for all. But you really have to peel back the layers and take a look. So we'd like to put it in this toolbox of 3 tools that can be put to work, so that as an investor is approaching a product, they can think about which of those tools are being put to work. So the first tool is a lot of what we've been talking about. It's using environmental and social standards in the investment process. So that's the need for disclosure. That's how we make choices with the information. And we put that under the umbrella of being better investors. So that's the first tool, is using that information, using those standards to make an investment choice. The second tool that we have is, once we're an investor, we have a seat at the table. We have a voice, and that's a very differentiated voice. And companies often care about that voice and will really engage and participate and listen to that input. And that can really create another level of impact, a deeper level of impact, by creating positive change where we see weakness. And we put that under the umbrella of being better owners. And then the third tool is investing in communities. We've heard a lot about income inequality, poverty alleviation. And sometimes when you're talking with investors, they're a little confused on that. It's sort of, well, how does that play into my, investment thesis? Well, we believe that all investments sit on a foundation of fairness and justice for all. So if there's disruption in that system through inequality, that will not be good for an investment portfolio. And we put that under the tool of being better neighbors. So as an investor is approaching, whether it's a mutual fund or an ETF, focusing on those 3 tools of being a better investor, being a better owner, and being a better neighbor, and how much is that manager putting each of those tools to work, I think will really help them to make that decision. In that context, you also want to look at history and experience, and you want to look at disclosure. So at Domini, we think, we don't just talk about our environmental and social standards, but we lay them out. We put them on our website. You can download them as a PDF. You can read through all 60 pages, and you can see what we mean when we say we're researching these environmental and social issues and how corporates stack up on that. So, just to kind of, wrap that up, every dollar that goes out to the world has impact. An investor gets to choose how they're going to channel that impact. It can be positive, it can be negative, but it's not only investors, it's investors, it's consumers, as we talked about. We see sort of this, a lot of investors leaning towards green choices. So there is a bit of work. I don't think it's overwhelming, but in the same way, you spend some time thinking about who's managing your money and what the financial returns look like when it comes to sustainable investing, those considerations. I think those three tools help guide that.
Well, thank you for that framework. Let's move to segment 3.